Well, apparently, I was not the only one wondering where the missing documents were. And the other thing that happened is that nobody was given the bank side of things. They had these attorney generals that were making the rounds of the news shows talking about the settlement, all the things that the banks didn't get out of it, they mentioned. But it wasn't really clear what the banks did get out of it. And apparently, they don't get a lot of civil liability protection. The primary protection they get is against civil suits by the state's attorney general, primarily the robo-signing, but also servicing civil suits and also origination loan. Going back to the loan origination, which was a big deal for a couple of the big banks, Bank of America and to a lesser extent Wells Fargo, because both of those companies kind of ended up with entities that had done a lot of, particularly Bank of America had ended up with Countrywide, which was apparently one of the worst abusers of the poor documentation and in terms of making the loans and not verifying income and jobs and other things in making the loans. So they wanted some civil liability, but it's not civil liability. They do not have civil liability from individuals suing, and they do not have liability from investors suing. And in particular, about the individuals suing, that may have been where I was wrong. Nevertheless, the documentation is not out. There is a website that's up, the government website that's up that's supposed to house the mortgage settlement, and it's instead of being a .gov, it's nationalmortgagesettlement.com, and that's the landmark settlement, landmark relief is the title at the top. But the documents still aren't there. The settlement itself says coming soon, and this is now almost a week. We did the original one on Monday with no information. There's a good article in American Banker. I think if you Google mortgage settlement details and put American Banker somewhere in there in an advanced search, you can get to that and read that. And they suggest, and they have people on the inside who, as sources, that the document hadn't been signed yet. And that for whatever reason, I think they got all the attorney generals online. For a while there was this attorney general didn't want to do it, California didn't want to sign, and then the people in other states, particularly Florida, Pam Bondi in Florida, she didn't want to sign anything if California got a better deal than her. I mean, that was the big thing. We don't want the people in Florida don't want to wake up and find out that California got a better deal than the people in Florida did. So I guess the big thing that they managed to do was get all the attorney generals online. There's I've seen several other things on the web saying don't worry about it. The documents are up, or they're waiting for it to be certified by the court, by some court, or when they get through the court documentation part of it, that they'll post it. But at least I wasn't the only one in the country. So kudos to the American Banker for putting out an article explaining that they didn't think, and based on their information and some inside contacts they had, the settlement has not been signed and has not been finished. Now it was a lot of people may be wondering why you had all these states' attorney generals led by the Iowa Attorney General, who, when Iowa was not even a foreclosure state, why are they so upset about robo-signing when Iowa's not even a judicial foreclosure state? And it's only in the judicial foreclosure states that we really have had this big problem. It first was noticed in Florida, and I talked about Daniel Stern's operation down there, the factory setting, the assembly line of foreclosure, and he was able for $1,400 of foreclosure instead of $10,000 of foreclosure. But in order to do it, evidently they had to backdate some documents, and they got caught backdating some documents and some other stuff. And now it's turned out that this is a systemic thing, and many of the other servicers or their subcontractors to them engaged in the same practice. And we talked a little bit last time about the fact that, if somebody doesn't pay their mortgage and then they get foreclosed on, that's a kind of organic process. Especially if they get to live in the house for 2 years and are 1,000 days, which is closer to 2.5, 3 years. They get to live in the house and without making any payments, rent free, no payments, and then at the end of that, they get foreclosed on. And if somebody in that process, signed a document without actually scrutinizing all the details, was that a fraudulent foreclosure? I mean, the key facts of the situation are the same. Person didn't pay their mortgage, they got foreclosed on. That's an old policy. If we didn't have foreclosures when people didn't pay mortgages, then there would be no loans to get mortgages. I mean, that's part of the deal. When you sign your bottom line saying they're going to lend you $200,000 or $300,000 or more to buy a house, if you don't pay up or you get too far behind in your payments and they clearly feel like you're not going to make the payments, so they have the right to foreclose. And the system in some of the judicial states is very convoluted. And there are a lot of steps and challenges for discovery of documents and things like that. And somebody that hires an attorney to challenge the process can really slow the whole thing down. And of course, on the right, you have the people are saying, we needed tort reform. Where was George Bush in tort reform? George Bush ran on tort reform in 2004. That was one of his key planks. As soon as he got elected, it kind of disappeared to the chagrin of many of the people who supported him and still want tort reform, and that the problem is too many lawyers in the process. And it is true that many of the states that have due on sale clauses, instead of judicial foreclosure process, where you don't have this 2.5-year waiting period, those states seem to come out of the housing crisis best. And in many local markets where you live, watching this podcast or listening to this podcast, where you live, there may not be a housing crisis anymore. You may see builders may be putting up homes. Prices seem to have stabilized. Now, the people who bought at the height of the market, they're not going to be able to turn around, and if they need to move for whatever reason, they may not be able to turn around and leave just whenever they want. I mean, they may be underwater. I think there are a lot of people out there they're going to be underwater for a number of years, because it's even if we have a normal kind of healthy real estate market where the prices go up reasonable amount, like other investments every year for a period of years, you've got quite a ways to go in many areas just to get back to 2004, 2005, 2006 prices, and we may not be 2006 prices, probably more accurate than 2004 prices. We may be a long way away from those people ever getting back to normal. So the one of the things that they did do, and I think we talked about this, the problem with the way that mortgages were packaged, bundled, and securitized was that the, quote, investor was not an investor, but it was, in many cases, a bunch of tranches where this group gets the first money that comes in, and the next group gets the next money that comes in, and the next money gets the next money. And what happens when you have that type of situation is that it is very, very difficult to get in touch with a lot of those people. Some of those entities are bankrupt. In other words, somebody may own some company may have gone out there and purchased some hedge fund or some other entity that went out there and invested in mortgages. Many of those companies are broke. I mean, when the mortgage crisis hit, those companies went belly up. So you have a homeowner that has a mortgage. They want to restructure the mortgage, maybe get a longer period to pay, maybe get a little bit of forbearance of a situation where they were out of work. Now they're working again. They're able to make payments. If you could restructure the loan and put some of the stuff that they missed back in there, they would stay in the house and keep paying the loan. But on the other side, you have all the investors, the group, all the ownership of that mortgage is so complex, including businesses that have gone under and don't have anybody to make a decision for them. And they may have passed it, whatever happened to them, their rights may have gone over here. And in some cases, you have servicers that are mailing letters to addresses that have disappeared, businesses that have disappeared, hedge funds that have disappeared. So it's very hard for them to determine, where all these people are. Okay, what if this company here went belly up, and they have a right? I mean, that's an asset that they have. It should have gone into the bankruptcy or however, whatever happened in terms of the dissolution of that entity that went belly up. Somebody may have ended up with that, but the paper trail on that may be very hard to uncover and find. And so what we have here is you have a situation where transactions costs are being increased on many sides. And you can think of it, liquidity is not the right way to look at it, but you can think about it as like in a situation where we created unnecessarily illiquidity in the mortgage market processing, where the dealing with the investors on one side is very complicated. The loan servicers have an incentive. In some cases, they may hold seconds, or they may get extra fees by dragging the process out. They have an incentive to be very slow and not do it. And then you have states, and some of the states are guilty of having convoluted, unnecessarily complex judicial foreclosure processes for something that ought to be handled basically, according to the rules of contract law. Some people don't make payments. You give them a chance. You try to work things out. After 6 months or so of not getting payments, then it's got to come to of them not making the payment. It's got to come to head. It doesn't need to wait 2.5 years. There's no reason, no justification in that. The places like Florida, where they have the longest wait on foreclosure, Florida, Arizona, New York, have the longest wait on foreclosure. Those are the places that have the worst markets. I mean, where the real estate market is really still hurting, is still in not even a recession, a Great Depression. I mean, those areas have really had a Great Depression in terms of the housing prices and the housing market. So one of the things that they did do was the state's attorney general, and somebody did a good job on this, and I guess that's why they chose the guy in Iowa, was that they went through and they created some basic standards for how foreclosures are going to occur, giving people a chance to do a resettlement, to giving them 14 days notice, generally in a series of steps, giving them 14 days notice, giving them the option of asking for restructuring, and then if they ask for a restructuring of the loan or they ask for a workout of the loan, then the foreclosure process stops until that process of them asking for until that is all worked out. And in some cases, the bank or the investor may say just no, I don't want to work it out, I'm going to go to foreclosure, in which case they have to make the payment. But they have to at least work on a workout for some sort of solution. And if you get notice as a homeowner, you get notice that you're being foreclosed on. They give you a number of different options. You say to them that you would like to work out a deal, or to restructure the loan, or to try to find some way to get out of it, to work out of it, and they're supposed to give you that chance. And there's a lot of good regulation there, I think, that kind of standardizes things. It limits the fees that can be charged. It prevents some of the worst abuses of the situation where people thought they were working things out, and then in the end, and I think in a lot of situations when you talk about working things out and you got all these different, your mortgage the money that you borrowed, the rights to receive that money are now spread out among all of these different entities, and getting all of them to sign off on it, it actually just becomes easier to foreclose for the bank servicer than it is to work it out, because it's just so. And then maybe one small most of the investors may, if there's 10 different entities that are involved in the process, 9 may say, yeah, let's work it out, and 1 may say no. One of the things that future mortgage contracts, there has to be a single entity that has the right to say yes or no to the process. In other words, none of this like voting, and it has to be unanimous. You can imagine, all these investors are spread out all over the world. They don't know each other, and they have all got to approve and all the investors have to approve the restructuring of your mortgage, well, you can imagine how easy it would be for one of those to say no, and that's the end of it. When the mortgages are set up and the servicer needs to work with one entity that's designated to make decisions about the way that mortgage is going to be worked out. If there is a restructuring, or if there is something is done, some sort of even principal forbearance or any of these other things that are going to happen, there has to be an entity that makes that decision. There are a lot of different rules on how things, not doing the robo signing, any legal affidavits have to be done. There have to be certain things that are put into a pre-foreclosure referral notice, and then once the person that has the mortgage, makes a decision that they want to work it out, or they want to do all that kind of thing, either HAMP or whatever it is, that the banks have to try to do that first. They can't go pursue foreclosure over here, and so that dual track is prohibited, or at least restricted, and so you don't have those types of things. Even after the foreclosure is in process, there are some different rights that they give to the buyer to get straight. They have some rules on processing payments and things like that. I think a lot of people thought they were going on and making payments thinking that the bank was going to restructure the loan. And of course, it may not be the bank that had the final say on restructuring the loan. In a lot of cases, if you're dealing with one of these bank servicing companies, you think they hold the loan. They may not hold the loan. But that people were making, they would get in a deal where they were working on over here, they were working on a workout to it, and they said, as long as you keep making payments, you're okay. But over here, they're working on foreclosure. And then the investor, or whoever held the mortgage, at the end, they said a decision, no, we don't want all this. We want this. Well, then the people have been making payments, and they were doubly irritated, because if you're going to be foreclosed on, you might as well just stop making payments. So they were making payments up until the time, and then all of a sudden, next thing they know, the workout had been rejected and they had been foreclosed on. So there are a lot of good protections if there's anything that's done. I think the servicing standards that have been set up and negotiated by the 50 states' attorney generals, and of course you can say, well, this is government interference, it's government regulation, but some regulation is good. I mean, if we didn't have, for example, in countries where you don't have a uniform commercial code, which is a legal regulation on how business works, how the rules on little things like the fact that if you mail in a payment to somebody, the effective date of the payment is the date you mailed it, not the day they received it. So that's part of the Uniform Commercial Code, for example. Little things like that, and our system of contract law really makes business work more effectively. I mean, everything it's said about the lawyers and being too greedy, and we have more lawyers than anybody else, and in other countries, and I know I've lived in Korea and talked to people in Europe and China and Asia, and we do work things out too often here in court, and there are too many lawyers and there are too many lawsuits, and I think probably some sort of tort reform probably is a good idea. But at the same time, our legal system, which gives people the right to seek redress in court, is an important lubricant to the process of capitalism and the working of markets and the working of contracts. And without that, we would not be as well off. Now, exactly how much money the banks have to pony up is still not clear. I mean, it's clear that the states, the attorney generals, are getting a big piece for themselves, some of which will go to help people. Most of the states are going to put a little bit of that money to helping people, and they're going to spend the rest of it covering the budget deficits that they've had, upcoming budget deficits, a lot like the tobacco crisis. Here in Tennessee, we got this huge tobacco settlement, and the money was supposed to go to help the tobacco farmers. Tobacco farming is big here for people that don't live in Tennessee, to help tobacco farmers transition to other forms of agriculture and to other types of things to help farmers and to help the agricultural system here transition. And what basically they just spent it all fixing the budget one year. 500 million or whatever it was that they got, some huge amount of money. They're we had a budget, I think in those days around 21 million, and we were half a billion, 21 billion. We were half a billion short, and they just took the tobacco settlement money and said, okay, we're okay for this year. Everything's okay this year. We'll just use that. And that's probably what will happen with most of the states getting the money. Some of the money will go for deficiency judgment, and that's not even real money. A big chunk of the money, evidently, that's going to go for the workouts and for helping the people that have been foreclosed on. A big chunk of money is going to go to help people refinance, people who are underwater but current to refinance. And that's a good thing, I guess, if you can't refinance. Many people have been able to refinance. I know in Florida, I know a number of people that have been able to refinance even when they were underwater, just because it was in the bank's interest to do that. If you had a 7.5% loan, say from 5 years ago, and at the top of the market from another bank, and you go to a new bank and say, look, I'd like to refinance this, and you paid down enough so that you had, you weren't 97% into the loan that's underwater, but only 80% or 75% into the loan that's underwater. Many people have been able to refinance, but I guess in some places they've not been able to refinance. Some of the money that there's a big, I think the biggest pot of the 25 billion is going to go for stuff like that. Now there's going to be some principal forgiveness in some situations. I don't see a lot of principal forgiveness other than the principal forgiveness that occurs in a short sale. And if the money that is going to go into of the 25 billion, if like 17 billion of that is money that is going to go into principal forgiveness, but only through short sales, deficiency judgment forgiveness, which is money the banks a lot of times have written off anyway. In other words, if the bank forecloses and they're out a couple $100,000, we talked about this last time, technically they have the right to go and pursue that person later on. If they ever get any other assets, they have the right to go and pursue them some other time in the future. But in many cases, they just write that off because the probability is they're never going to collect any of that money. And in their own bank, in their own books, anyway, they write off. Now, just because somebody doesn't write something off doesn't mean you don't try to collect it. I mean, it shouldn't pay you. They may be referring it to contractors and collection agencies and people like that to eventually try to collect that money. But there's some of this is going to go into forbearance for that, and I think that's one thing that's probably we should have worked on early on, was some sort of way, and I said this the other day, if we wanted to fix the crisis early and we want to be out of the housing crisis and we want the housing market to have already recovered, one of the things we would have done was to get people out of their homes, people that wanted to get out of their homes, get them out of their homes quicker. People that, if somebody's had, like you have a 2-worker family and somebody gets laid off, and you're living in a house that you can't afford and is way underwater, you're better off getting out of that house and going and renting somewhere. If it's going to, you're going to be on it, somebody's going to be like a middle manager or something like that, and there's a lot of people my age that got laid off in this crisis, and the jobs that they had when they got laid off, if you get to be my age and you get laid off from a job, chances are you're going to start back at a quite a bit lower level, and that's even if you, unless you want to just stay unemployed forever and ever and ever, you're going to start, you're going to get back into the workforce at quite a bit lower level. Letting people out of those homes is the best thing. I think we should have done more to let people who want it. That's not what the banks want. And I think when the Obama administration and what they wanted to do, it sounded like they wanted to help the homeowners. And it sounds like they're really against the banks. And, there's been a lot of, I think, for one thing, the thing that really irritated the Obama administration was that the big banks and the big operations that were bailed out, and including Goldman Sachs and others, were given 100 cents on the dollar. As AIG counterparties, for example, when most people, and myself included, said, you can't bail those people out at 100 cents on the dollar. They got to take a haircut like everybody else. But I guess at that time they had to make so many big decisions so quickly. And actually, I guess the AIG bailout originally occurred under the Bush administration, not the although it was Bernanke and those that worked it out, the former Goldman Sachs people working it out for Goldman Sachs, and J.P. Morgan and people like that. So they, once they got the bailout and then everything was done, and then they wanted to, of course, the Dodd-Frank rules and all of that was being discussed, they went and spent a lot of the money that they got lobbying very hard to keep from being regulated again. So they took the bailout, survived, and then as soon as they were reasonably not healthy, but as soon as they were on their halfway up on their feet again, the first thing they started doing was lobbying to keep, so that they could keep doing things the way they've been doing it that caused the crisis in the first place. And I think they really irritated the Obama administration, and their rhetoric has been kind of for the little people and against the banks, but it had the opposite effect. Many of the things they did helped in the people who caused the crisis more than it helped the people who were hurt by the crisis. And I think if we had to go back and do it again, some sort, and I don't know whether it's if you pass a law in every state where you have deficiency judgment forgiveness. In other words, if somebody gets a mortgage and they end up being foreclosed on, that the bank can't pursue that mortgage foreclosure is a kind of final act, and there's no redress against that. And some states have that law. Hawaii, I know, for example, has that law. If you have rules like that, or if we had instituted something like that, then I think we would have fixed a lot of this to start with. The other thing is that I don't think people recognized, and I was on Business Matters talking about this, right at the height of the robo-signing, when the robo-signing, the height of the hysteria over robo-signing, and I said, we really need to get this thing solved right away. And it's taken, 15, 16 months to get it solved. Meanwhile, if many of you live in a neighborhood where you've got a house that's just been sitting there, and may not even be people living there, I know in my, I have family members that own property, and you drive by and there's a being foreclosed upon house that's up, and there's a notice for short sale, and for like 2 years it's been sitting there. Nobody's doing anything. Nobody's taking care of it. They're waiting for the foreclosure process. The people aren't even living there, staying there. And in many cases, the houses have been abandoned. The people have forgotten about them. So the states that have the judicial foreclosure process got to look themselves in the eye and say, do we really need to have a bunch of lawyers involved in what is a really simple thing? If somebody makes a payment on their mortgage, everything's fine. If they start missing payment after payment after payment, it's not good. And there was a show on CNN where they tried to profile this one family that was being foreclosed on, and they're going to lose their home. And then it was talking about how bad things were, and the whole thing was to make you feel sorry for the family. But then when they actually went to the hearing, they said they'd missed 23 payments. And that wasn't emphasized. That was kind of in the background, that they'd missed 23 payments. And I'm thinking to myself, so they've lived in this nice house, a nice neighborhood, upscale neighborhood, 23 months without making a payment. Gosh, that's an awfully good deal. That you should, if you didn't make any payments on your house, they probably got a pretty nice nest egg put away to rent someplace nice. So the people who have suffered the most because of the malfeasance of the banks and the robo-signing, but also because the response to the crisis by the policy response by the federal government, in many cases the policy response by the state governments, has been very, very poor. And the people who've been hurt the most are the people that are underwater and are paying. Even if you're not underwater, but you are paying on your mortgage, or you own your house outright, and you're not one of the people that is being foreclosed on, but you're one of the people that own your land, fee simple or making a mortgage payment or however that works. You're the one that's been hurt by this the most, and particularly if you live in one of these judicial foreclosure states that are having the most problem, where it takes 1,000 days to foreclose, and you got these blighted homes. Even nice communities in Florida, you see these homes that have been abandoned and they're going to, nobody's doing anything for them. Probably the taxes haven't been paid on them, and so the whole thing is a really a mess. And in a sense, and I'm not for just like randomly kicking people out of their homes, but for many people, if your mortgage is underwater, if you can't afford to make a mortgage payment for whatever reason, one of the two workers has lost their job, they've had to go back and work at a much lower level. Maybe you don't need a 3,500 square foot house for two people. Maybe renting a nice 2-bedroom. If you got a married couple, the kids are grown. You're my age, your kids are grown. Maybe move into a townhouse, the 2,000 square foot townhouse, or a 2-bedroom apartment, where your kids can come visit you whenever they want. And you got a married couple that are going to be sleeping in one bedroom, and they've got a spare bedroom anytime somebody wants to come visit. Got a nice apartment. Maybe they're better off doing that. In some cases, maybe you're not better off staying in your home. And maybe the people who we've helped to stay in the homes would be better off if we just helped them to leave. Actually, one of the entities that's probably been the smartest about handling the housing crisis has been HUD. They'll go in and they'll say to a homeowner that's not making payments. Many times, of course, if it's a HUD loan, it's in an urban area. You're talking about smaller houses. It's usually not a lot of money, and they'll go in and they'll say, "Look, if you'll clean the place up, if you'll clean the place up, agree to a quick foreclosure, we'll give you like $1,800 to go rent someplace else." And place has got to be clean. It's got to be neat. We got to come in and do an inspection. And then as soon as those people move out and they go ahead and agree and move out quickly, sign all the foreclosure documents. They don't fight the foreclosure, sign all the foreclosure documents and move out. And HUD has been very successful in turning their properties around. I know I have a former student of mine that's a real estate agent that here in this area that specializes in HUD properties. And he says, a lot of those, they come out looking right at the minute they go on the market. They look nice, and they put them up for auction. They're getting good prices for them. Sometimes he said, the people will bid on an auction for them more than the listing price. If they eventually put it to auction, so they've done actually very well. And what have they? If you look at what they've done versus against what the Obama administration, a lot of their plans is that they have given people a nice incentive to leave the home quickly in good shape, as opposed to trying to force them and get them to restructure the loans, give them more time. If you don't have principal forgiveness, if a home is underwater, unless there's some principal forgiveness, which investors are just not going to want to do unless you drag them kicking and screaming. And most of the time when you have principal forgiveness, as I pointed out, principal forgiveness primarily occurs when in short sales, where it's a matter of foreclosure on the left hand, or giving up a little bit right now and avoiding, because we'll lose less money in a short sale than we'll in a foreclosure. And the banks have to look at it, and investors have to look at it that way. And in many cases, some of the investors that now hold the mortgages bought them at very deep discounts. So even if they get 80 cents on the dollar, they bought it at 55 cents on the dollar or 35 cents on the dollar. If it's an Alt-A or prime mortgage, so they, getting 80 cents on the dollar, 75 cents on the dollar for them, it's actually not they're making money at that. So you have unless you have principal forgiveness, all you do is restructure the loan. So you put the payments they've missed and the principal reduction that didn't occur because of payments, and you restructure the loan, and now they have another 30 years, or you spread it out to 40 years go from 15 to 30 or 30 to 40 or whatever, give them longer time to pay so that you can cut. And also, of course, because We do have one thing that the main encouraging thing in terms of getting us out of the housing bubble, out of the housing crisis, is low interest rates. We do have record low long-term interest rates so that people can restructure those loans and borrow the money again. Now, the fact that you're getting a lower interest rate is good. And that does save people money, but it's not really, particularly if they've had a loan back 6 or 7 years ago where they paid 6 or 7%. But people that have bought houses and are paying, moving from 6% to 4.5%, the fees and everything involved in that, you don't really save that much money unless you can go down at least 2 percentage points. But so restructuring, in other words, reworking the loans out so that they have longer to pay, doesn't really help homeowners very much unless you have principal reduction. And I'm really hesitant. I really don't expect to see a lot of principal reduction, even though that's what everybody talks about, and a lot of this money will go for principal reduction. I don't think you're going to see a lot of principal reduction other than short sales. Other than short sales, it is also true. I think that the Republicans do have one point of and Romney said this, and I don't agree with much Romney said, but he did say, if we get the foreclosure process running, the worst thing is when the foreclosure process is frozen. This robo-signing froze the process in many cases. And one of the, there's the 1,000 days, a lot of that is because the banks themselves have been hesitating. There is also something else that has been happening lately, and that's where people are being paid a lot of money to move out of their house. People are given like $20,000. If they'll just go ahead and sign the foreclosure documents now, we'll give you $20,000 to move out and move on to the next house. Now, you would think those have to be pretty big mortgages, but it turns out that some people have been offered quite a bit of money to move out of a house that they don't owe that much money on to start with. People have a mortgage for $80,000, and some bank will come in and offer them $15,000, $20,000 to move out of the house. That doesn't make sense, does it? And one of the things that one of the experts in this area said was that there may be some situations where they do not have the documentation to actually do a legal foreclosure. So what they're doing is they're offering people these huge incentives to agree to the foreclosure process and fight it, because if they did fight it, the bank or the investors couldn't win because there's documentation that's missing or lost. And so they have a very large incentive to get those people out of the homes quietly without any fuss. So there, you might, if you are one of the people that gets one of these offers, generally these offers cannot be negotiated. They make an offer, it cannot be negotiated. You have a certain amount of time to take it. Otherwise, they move on to the foreclosure process. But a number of people have taken these deals, and it's being widely reported. So you may see that occurring. Now, it may be that the skeptic who suspects the worst and suspects that the only people getting these offers are the people for whom the mortgage documentation does not exist or has been lost, so that if they fought the foreclosure could never go through. So that may be the truth. It may turn out to be a general strategy that you're going to see more of from the banks, where they just pay people money. We'll give you some, if instead of making us wait a year and letting this house deteriorate and all the lost interest and all the expenses involved, if you'll just move out now, we'll give you $10,000, $15,000, $20,000 right now. If you just move out, sign the documents, give up your rights to the house, and move on. And so we may see more of that. It is actually a good thing if foreclosures proceed, particularly when people aren't living in the houses. I mean, people want to stay in that house and live in that house. It's probably better. It's not better for all involved, but it's better for the banks, it's better for the investors, it's better for the business people if you can work it out and keep those people in the house. But in situations where people have abandoned the property and it's just sitting there, nothing's happening, it's deteriorating, it's not being taken care of, speeding up the foreclosure processes is absolutely what we need. And so one of the things that's liable to happen, and probably will happen, is that you're going to see a huge wave of foreclosures. in the next few months. Now, in the areas where those foreclosures occur, that's going to put a lot more negative pressure on the housing market. But if it happens when foreclosures happen quickly and the properties are in pretty good shape, they're not blighted and they're in pretty good shape, that's eventually going to help the housing market reach the bottom. And a lot of times markets are all about psychology. When you go up to the top of the bubble, there's a lot of unreasonably positive psychology. Irrational exuberance is the term that the chairman of the Fed chairman before Bernanke, and I can't. All of a sudden, I've got a brain lock and I can't remember his name. Federal Reserve Chairman Alan Greenspan. Gosh, how could I forget Greenspan? He's like my Federal Reserve Chairman for like 18 years. Alan Greenspan used the rational exuberance when things get to the top of the bubble. When things get to the bottom of the bubble, there's irrational negative opinion. And I have recommended to the finance professors, I said, instead of focusing on all these formulas and worrying about this type of thing, one of the things you should do is you should have people go and read newspapers from the era at the top of the bubble. Go and read newspapers in Florida in the late 1920s, when they're talking about real estate prices and what people are saying about real estate in Florida in the late 1920s, right before the big bust. Go back and read the big, huge bear market that occurred in the run-up to the 74-75 recession. 74-75 recession, economists don't agree with this. They think the 81 recession was much worse. But to me, that was the worst because it was such a long downturn. And also the negative psychology at the bottom of that trough was probably the worst ever. I think during the early Reagan, they kind of created that recession in order to get control of inflation. And I don't think you had the negativity or the overall negative feelings during that time that you had during the 74-75 recession and where the stock market fell by more than 50%. And if you go back and read when the Dow was in the 500s and the market was going, that process of the market going down, how negative people were. Literally, you had AP articles. That's the AP is, doesn't, if you think about an AP article, they report just the facts, ma'am, and they report the facts, and they don't take a lot of chances. They don't make a lot of predictions. They don't step very far out. You had AP articles suggesting that capitalism wasn't going to work anymore, that capitalism had only worked in times when we had excessively cheap, unreasonably cheap oil or coal or other means of fueling the engine of production for capitalism, and that the whole system, our whole system of living, was never going to work again the way it had before, because we were never going to have this super cheap oil, and that we had run like on a borrowed time for many years and built up this massive economy. And the massive economy was all a shell game built up on cheap, unreasonably cheap, subsidized oil. And now that the Arab oil embargo had started and OPEC had started, we were going to have to pay a more reasonable price for what was time was not reasonable, but an excessively high price for energy, that everything wasn't going to work right. I mean, that we were never going to be the same again, and how negative that publicity was. At the same time, you go back, and if there's old CNBC shows, watch CNBC as the NASDAQ is going up to 4,000, 4,500, 5,000. Look at how unreasonably exuberant everybody was about the market, and all talking about IPOs and talking about mergers, and this company is going to maybe buy this. What they should do is this company should buy this company, and this company should buy this company. The time in which AOL was valued at $140 billion. Can imagine a company like AOL, which doesn't really do much except provide dial-up internet access. At that time, it was primarily an internet dial-up internet access company. They were worth more than Time Warner. I mean, they merged with Time. They bought Time Warner and it became AOL Time Warner. The capitalization of AOL was more than Time Warner is one of the biggest cable companies. They've got all this, fiber optics and everything for cable lines. They have their movie studios. They own all these television stations. This big, huge media conglomerate, and they're not worth as much as AOL. And of course now, that was the marriage made in hell. AOL is not worth anything. They still have a few people that pay them $20 a month for dial-up service, I guess, but they're not worth anything anymore. So you had the irrational exuberance or the positivity that occurred then. What the housing market needs is some positive news or some positive feeling. And until you get the blighted homes out of the neighborhood and all those, the signs up, short sale and foreclosure sale, as you're driving around Florida, you see these foreclosure sale signs or foreclosure auction signs. Many of the little small banks have gone belly up, and what the FDIC typically does when they come in, they don't want to let all the properties out at once, but they auction off a lot of the properties that are around at that time, and so you have until that is fixed. In other words, until the foreclosures, this massive wave of coming foreclosures, until we work that through, there's not going to be a recovery in the housing market. Where you have recovery in the housing market now is in places where that process is finished. And there are still, you might still have a foreclosure here and there, but by and large, the big wave of foreclosures has already taken place in, a year ago or a year and a half, 2 years ago. In areas like that, the real estate market is doing very well. Now, we don't have very good evidence. There is the Case-Shiller that keeps getting reported. That's only in the 10 biggest metropolitan markets in the country. And the evidence, that we do have generally comes from like the Board of Realtors, and they have an incentive. The Board of Realtors in different areas, of course, have an incentive to say that the market is doing much better than it is. And so nobody really trusts any national data. The Board of Realtors, they do report things like median home values. And what does a median home value tell you? If the median home value can go down for a lot of reasons, it can mean that they're building smaller homes. It can go up for a lot of reasons. It can mean that they're going up because all of the poor people have been foreclosed on and they're now renting. And the only homes that are being built are contract homes for people in high incomes. And that'll raise the median home value in an area. When you have the homes that are on the market or for sale or at a higher value than when that value of those homes go up, then you have a rise in median home value. It doesn't really tell you much of anything. Median home value doesn't. The Case-Shiller is much better. It's for all the criticism of it, it's definitely the best index that's out there, but it's only in 20 markets. And there is another Case-Shiller index that you'll see reported to from time to time, but it doesn't have nearly the rigor in terms of the data, the way the data is analyzed and the way it relies too much on forecast and other things. But the Case-Shiller, the 20 metropolitan market Case-Shiller is a good index, but real estate markets are very local. The area where you live, if there's a new factory coming in or if the foreclosure wave went through 2 years ago and is all done, your market is probably returned to normal. Now, if you're in Las Vegas, Arizona, parts of many areas of California and Florida, New York, the market hasn't improved, and it won't improve for a while until these foreclosures go. So if there's anything that will come out of this mortgage settlement, and I was really negative about it when I talked about this on the Monday following the settlement, primarily because nobody was asking for the details. I mean, it was so irritating to see these attorneys generals being interviewed, and nobody said, well, can I read the document? And American Banker said, well, they wanted to read the document, and they even said in their article that why did none of these journalists ask if the document was going to be available, if the details were going to be available? Because honestly, in a deal like that, the details are the key. Until I actually read the document, I'm going to reserve judgment, but I think it does two things well. In areas where the foreclosure process has been held up for a long time because of the robo-signing issues, and because the banks were scared to move forward because of that, I think that maybe you will see some of these foreclosures that need to go through. There are a lot of foreclosures that need to go through. Anytime the homeowner, nobody's living in a house or building, that foreclosure needs to go through. It benefits absolutely no one for the process to be delayed. It actually hurts everyone. It hurts the neighbors. It hurts the people, whether you're a neighbor or you live in that same housing market, because it depresses the entire housing market when you have those. So foreclosures that desperately need to go through, where the homeowners long abandoned them, nobody's living there, those things need to happen. And the banks need to go ahead and start processing those. I think in one sense, many of the banks don't want to have been very slow foreclosing, and this is true especially of your smaller banks, because they don't want to take the hit to their books. If they go through the foreclosure process and there's the asset here, and then there's what's owed to them, and then when the foreclosure takes place, they got to mark that down to value. They're supposed to mark it down to value anyway, but they don't. And then they have to mark it down to value. Well, they usually get a real estate opinion, and they get a couple real estate agents, and they get an opinion, and then they put that out as the value of the home. Well, they usually pick real estate agents to do this, who are going to give them a high value. Just like during the crisis, one group of bad actors in this thing were home appraisers, because they would come up with these unreasonable appraisals. And I know builders in the area where my son-in-law was working as the number 2 man at a home building operation, that they could get an appraiser if they needed to sell a home, and they needed an appraiser to come in and say this home is worth X. There was one, they could find one. They always knew who that appraiser was, and they always seemed to manage to get everything appraised. And so one of the sets of bad actors in this whole process, and one of the things that needs to be fixed, is the home appraisal system. Maybe something similar to what's done with VA loans, where the VA just won't let appraisers that inflate, and they have a lot of really tight standards, and they're very restrictive, and it's whoever the appraisal process on loans is randomized. In other words, you don't pick who you get to be your appraiser if you want to get a VA loan. And some appraisers that will, if it's a VA loan, they'll appraise it at the real value, and that same appraiser, if it's just a regular mortgage with a bank, they'll appraise it at this value. Because the VA forces them to do things right. So we may need some system. We need to fix that system of appraisals. But the real estate agents are going to give that bank a high valuation for that. Well, now at that high valuation, that home's not going to sell. And I know a very good example. Wakulla Bank foreclosed on a home in our area, and a friend of mine bought it. A close friend bought this home, but he went in. Somebody had been appraised at $460,000. Somebody went in and got a 80%. They paid cash for it. A lady had paid $460 cash for this place. Well, she knew the market was dropping out, so she went down to friendly Wakulla Bank, and she got an 80% home improvement loan. 80% to value home improvement loan. Wrote herself a check. Didn't do any home improvement. Wrote herself a check for that 80%. Now, 80% of $460,000 is like, I don't know, $360,000, $370,000, whatever it was. I guess, or the low 400s. But she borrowed that money. Well, then, I guess even in the low 400s, when you get unpaid principal, interest, and foreclosure, well, when Wakulla Bank foreclosed on that property, they put it on the market for $295,000. Well, my friend went in and offered them like $230,000 for it, and was probably offered them $215,000, and they lowered their price about $5,000. He offered them like $225,000, and somewhere in that range, in the low 200s, in the mid 220s or something like that was his final offer, and they just laughed at him. And he knew somebody that worked at the bank, and he said, "Can't y'all get them to make a deal? Can't you get them to make a deal on this thing?" And they said, "No, they can't." He said they can't. He said they can't sell it at that, because then they have to admit the loss. And I said, well, they got to market at the value. Well, they market at the value that they have it the real estate agents, friendly real estate agents, they got to say that was worth this much, minus the real estate agent's commission and closing costs. Well, that's what they have it valued on their books for. If they sell it to you for $225, then they have to admit that they made an even bigger error than they made, and they have to take that. That's a loss on their books. They can't afford to take any losses on their books. They're already operating under a cease and desist order from the FDIC. Well, then a few minutes, a couple months after this, Wakulla Bank gets taken over by the FDIC. And many of their good assets their deposits and stuff like that, go to a bank out of Arkansas, I want to say Centennial Bank out of Arkansas. I'm not sure about that, but I believe they're the ones that took over Wakulla Bank. Then the property goes up for, the FDIC takes the other stuff and auctions it off. And this property is actually still in good shape. It's not one of these that's deteriorating or falling apart. It's a well-built house that my very close friend was going to bid on. Well, my friend didn't realize it was going to FDIC auction. The FDIC sold it for $138,000. And my friend went and bought it from that guy for in the 170s. So in other words, the Wakulla Bank was offered $225. Really would have liked to sell it $225, but felt like they couldn't because they couldn't take the loss. And then this is, stuff that we know from the inside. Well, when eventually that property sold for $138,000. I mean, they end up getting $100,000 less. Now, of course, it was the FDIC taking over the assets of Wakulla Bank that eventually sold it. But that's a good example of how the getting the banks to figure out how to deal with this is not very easy. Whenever they sell something, they got to, if they get rid of it, they have to get rid of it at the market price, and they may not want to do that. But just because even if they want to get rid of it at the market price, they can't because they feel like they're taking a loss. So the foreclosures that need to happen. Then when those properties come out on the market, the banks need to sell them at the market price. They need to try to get rid of that inventory of REO properties, and you try to get rid of that stuff. They need to pay the taxes on it. Several of the banks, Bank of Jackson County, got in Florida, and this is, you say, well, how can you take a chance on naming this bank? Bank of Jackson County, and Jackson County, Marianna is the county seat of Jackson County, one of the less poor counties. It's been hurt less than most other counties in terms of the housing crisis in Florida. Bank of Jackson County's got properties that they're not even paying taxes on them, and they got their REO properties that they're not paying taxes. Other banks too. Bank in Madison County that's had a bunch of properties out there they didn't pay the taxes on for several years. And then if you don't pay the tax, of course, you get all these fees, advertising costs and other things, and then an investor pays the taxes for you, and you can be charged as much as 18%, for somebody paying your taxes for you. But eventually, when you sell the property, you have to pay all that off. So you got to pay the taxes on it. And then you got to try to sell it at a reasonable price. You try to get rid of it at the market price. Don't fire sale it, but don't give it away, but sell it at a reasonable price. We got to work through the market, and particularly in when you have people that don't want to stay in their home, they've already left, they've abandoned it, they've already given up on that piece of property. They've already moved out. They're living in they moved to another area. In some cases, you have a situation where somebody had to move because of their job, or they got laid off here, and then they got a job in another city, and they had to move, so they just left that house and sent the keys to the bank, but the bank doesn't own it yet. It takes them 2 years to actually own it, so it just sits there empty. Work through quickly all the foreclosures that need to occur. Give people a chance, restructure where you can, because that definitely benefits the bank. I think it's also true that if you're one of these people that is way underwater, maybe you need to think about, and you don't have much equity in the home, maybe you're better off leaving, trying to work out a deal. We'll try to work out a deal with the bank where you are, they don't issue a deficiency judgment on you, and try to get out of that house and let the bank have it again. And if you cooperate with them and do it quickly, there may be some money in it for you. So I would just go and tell the bank, I want to be foreclosed on. And what do you give me if I let you have this house right now, as opposed to waiting 2 years when the house might deteriorate and I'm me living in it for another 2 years? Get out of it now. So I think having people get out, making that decision, getting all this done, is going to make and reaching a bottom. You have to reach a bottom, and then once you reach the bottom, the psychology of ascension occurs. And you now see even in Florida, you see a lot of investors going in and buying properties. Right now, they're buying properties and renting them. There's an article about a guy in California. He went out and bought a couple of these distressed properties, and he's renting them for twice what his payment is. In other words, he did it. He went and bought the properties on finance money, probably 80% financing, and then he's rented them out for twice what his payment is. When the rental market, you can make twice what your payment is on something. It won't take housing prices, because rental prices and housing prices tend to stay in a very narrow range together. If the rental market, if it costs a lot to rent and buying houses is really cheap, people are going to start buying houses and the market's going to start going up. So I think getting this settlement done, if it is actually done, and if there is actually at some point somebody actually posts the details on the website where they're supposed to post the details, this may actually be a good thing for two reasons. One thing, the two primary reasons it's good. Get the foreclosures done that need to be done. And number two, right away, that need to be done. Number two, the fact that some of these very poor process for handling foreclosures, because of the way the mortgages were securitized, getting that process fixed and having these basic standard things that have to happen. And I think the more you standardize something like this, the more people get used to it, the fewer mistakes that are going to be made. And when you have, it's like a situation where you have a set of rules, it's posted here, everybody knows the rules. Homeowners can come here and read the rules. The banks can come in here and set up their process so they follow the rules. There is going to be very strict compliance, and I thought that was impressive too. So the 50 state attorney generals, was very negative on them when it first came out. I couldn't read the details. I have a better opinion of what they did now, having read at least the servicing standard highlights that are posted on the website. Having read at least that, I feel a lot better about this. And then also, but the devil is in the details. I still need to see the settlement. Let us know what you think. Send an email to the website. We want to know what you think. If you have a really good comment, we'll be sure and tell me if it's okay to use your name and recognize you. Otherwise, I'll say somebody in Boca Raton sent this had a really good comment. But if you won't say it's okay to use your name, I'll use it. And it's possible that we may get you on here via Skype or something like that in one of the future podcasts.